The market for the fourth straight day are finishing on the green, and seems like this is a kind of a confirmation of the recovery that started last Friday. But today I want to talk about exactly what happened and what is behind what seems to be like a little bit of relief in the markets, even though it puts one of the biggest catalysts ahead of us in a really tricky position. And by that I mean nobody really knows what is going to happen, especially with earnings being mixed. I mean, if you just checked the futures after today, I mean, this Nasdaq is just tanking, like literally almost 2% based on earnings of Facebook that just missed. All right, so we have to monitor that tomorrow. But the thing is, today, you can see that everything was on the green. Dow Jones 0.6% up, S&P almost 1%, Nasdaq 0.5%. But there was also 2,000 still lagging big time, which is kind of weird. But we're going to talk about that in a separate video. Now, the thing is, this morning, there was a little bit of profit taking, especially as this market is really choppy. People were, okay, whenever there is a big jump, especially after these 3-4 straight days in a row in the green, people tend to take profit because you don't know exactly how tomorrow's going to look like, especially with earnings season being really, really mixed. Today you have Alphabet, which was really good. You had Nvidia really good, but Facebook not so good. And tomorrow we also have another big tech company giant releasing earnings. But today, what is really behind this growth, this green day, is really about these ADP numbers, all right? The US businesses shed 301,000 jobs in January. The biggest drop since the start of the pandemic. This is a big deal because the reality is the market and economists was really expecting to have 200,000 jobs created. So again, not, a retraction. So this is a gap of almost 500,000 jobs. And this is all due to Omicron, keeping people from going back to work and delaying hiring plans for company. So this plays out economically towards inflation, because one of the reasons why inflation is so high is because you have supply chain issues, because you have the demand not being met by the offer, but the offer is still lagging because of COVID, Omicron, Delta. People are not really freely and fully going back to jobs. So this is a big deal. Why is this a big deal? Because ultimately, with what the Fed is going to do, it means maybe the Fed is going to turn and listen to these numbers, because remember, the number one job of the Federal Reserve in the US is really about making sure that we have what we call full employment, meaning we have the lowest unemployment rate possible. And this is what just a couple of days ago, the article was published on January 26th, as you can see here. So it was saying that the Fed is ready to tackle inflation with interest rate increase in March that we already knew, pointing to a strong job growth amid the pandemic. The Fed officials think the economy is strong and the labor market is close to full employment, and it's time to address inflation. Now that we have numbers of January showing that the job market is not that strong, maybe that's the Fed thought, there might be an indication here that they're going to look and listen to, hey, you know what? Maybe we need to be less hawkish, meaning we need to be a little less aggressive when it comes to fighting this inflation thing, because by increasing interest rates, you know how the stock market reacted and tends to react, meaning it also have an impact on how risky and investing companies can be. Not as it refrains company from investing. It refrains company from hiring a lot. So it's a tricky position, and that's why on one side you have the Federal Reserve saying, okay, inflation is high, we really need to do something, but at the same time, we cannot do this and hurt the economy, especially with the job market. So it's a tough thing, but for stock market investors, especially the growth sector, it means, well, if this can be an implication that the Federal Reserve may not be as aggressive, so maybe in March we will not see an interest rate, and maybe it will be delayed to, I don't know, maybe April, maybe June. Nobody knows. I'm just thinking out loud. So that's why it means, well, we might take a little more risk, especially with the market being down so far since the beginning of 2021. So as you can see, this is, the one most chart. And yeah, the recovery seems to be strong. Since the last Friday, we gained 6% on the S&P 500. So we'll have to look at the next month ADP numbers in order to have a clear status on how the job market is performing, because that will be a very big driver into what Jerome Powell and the Federal Committee will have to do when it comes to fighting inflation, because ultimately everything's not tied up. Either the stock market dumps, either they refrain from doing what they said they will do in March and the stock market continue to go up, but in the meantime, the economy might get hurt. I mean, we just have to wait and see. It's a really interesting time on the stock market and economy now. So let's just see.